Good morning, everyone, and welcome to another session of the Festival of Enterprise COVID-19 webinar series. I'm David Stevenson, your host, and I would like to wish everyone a good morning. And I'm joined this morning by Simon Banks-Cooper and Chris Laws. Gents, good morning.
Good morning.
Hi.
Simon and Chris will be taking us through a presentation on cutting through the noise, practical tips and tactical advice for financial resilience during the coronavirus. Oops, I've just filled something, sorry. On an electrical cable. It's going to the joys of working from home. That didn't cause a fire, so we're in good shape. So sorry about that. Simon is a founding shareholder of TribeFirst, a Heropreneurs mentor and Honorary Colonel, a businessman, financier, and investor who's held a number of appointments as either CEO, chairman, or portfolio director of quoted, unquoted, and startup companies in the UK and overseas. And Chris is a chartered accountant who started his career with KPMG, then moved into industry. And Chris has worked at finance director level in a variety of business sectors and company sizes and has extensive experience of management control and information systems. So gentlemen, it's a pleasure to have you on this morning, and we're very much looking forward to hearing your presentation.
Well, thank you very much, David. And I should also add that Chris is also the managing partner of BCA, which is a firm of accountants and corporate financiers based up in principally in the north of England, but with offices, satellite offices, one in Leeds and one down in London. A business that I'm associated with, set up some years ago and then handed over the reins to Chris a while ago. What we were planning to go through with today was not to look at the detail of some of the various schemes, but to, because most of them now have been available for some time, and I think most people are familiar with the general terms. But what we wanted to go through was the practical experiences that Chris in particular and his team at BCA have encountered when assisting clients. And so looking at the practical aspects. So what we'll do is we'll kick off with some general comments from Chris. We'll then look at some of the challenges presented with the furlough scheme. We'll then look at some other major business costs very briefly. We'll then move on to the various financing arrangements, be it the bounce back, Sybil's and the future fund. And again, just share experiences that the team have encountered, that we've heard that the banks are having, some of the issues that the banks are having to deal with, and then share those experiences with you. So Chris, just to really kick off with, looking at the clients that you help, and it's probably worth pointing out as well that generally the sorts of clients that the firm helps, BCA is acting very often in the capacity of the finance function rather than a traditional external accounting, arm's length accounting relationship. So a much more detailed hands-on relationship. So could you just take us through some general guidance points before we get into some of the detail on the schemes, please?
Yeah, absolutely. Because although we've maybe we're maybe talking about the practical actions you need in difficult time, these are not hugely dissimilar to the practical actions you should have as good business practices generally, but the difficult times do bring them into sharper focus. Whilst many businesses can look at their cash and take a bit of a global overview when things are good, when revenues start to decline or when you have issues with costs, it becomes much more important to be able to manage your cash. So I think the first thing that we would obviously say as accountants is that you need your accounts to be up to date. It's obviously critical that you know where you are with your bank account, who owes you money, and who you owe money to. Without that, you don't really have a point to start with. Also, in the one of the things that we have seen with clients is that when they review perhaps their standing orders, that they might discover with the bank that there are minor amounts going out for things that they'd forgotten about or had intended to cancel but hadn't done so. So I'd encourage everyone to go through your bank statements, your transactions in detail, make sure you understand what they all are, and that particularly on the standing order side, that they're all essential. Examples might be small payments to perhaps accidental damage schemes for assets you've purchased, or similar kind of insurance arrangements that maybe you don't need now the assets have got a bit older.
And a major one, I guess, is the any direct debits that are set up for payments of VAT.
Yeah, I mean, this is that's quite a fundamental point. Now, the HMRC have announced a VAT deferment for all of the VAT returns between March and June this year. Now, you still have to submit your VAT return, but you should cancel your direct debit to prevent HMRC taking the money that would have been payable through the VAT. I would say that repayments are unaffected, so submit your VAT return and you should get your repayment. It's not clear at the moment to us from the data we've got whether HMRC are actually expediting those, because historically some businesses have seen VAT returns quite quickly, others have maybe had to wait a while or been subject to some queries from HMRC. I strongly suspect that HMRC staff are pretty much deployed on other COVID matters right now, so VAT refunds hopefully won't get too much of a delay.
Okay, so let's just, if we can, move on to the furlough scheme. Now, clearly this is something completely unprecedented. 6 weeks ago, most people had never heard the word. If I'm understanding correctly, we've got something like 800,000 businesses, 6 million employees are now on the furlough scheme. It's costing the government somewhere in the region of £16 billion a month to administer. And I'm very conscious that the Chancellor is due to make an announcement later today on an update to how the scheme will run. Well, most people will be familiar about what it's there for, but what difficulties, practical difficulties, have clients experienced in actually using it?
I think the first one was probably setting up in the first place, and the understanding that the furlough arrangements have to be an agreement between the employee and the employer. Now, I don't want to stray too much into the legal and contractual issues, because frankly quite a lot of the issues that came up around the furlough scheme were relating to contracts rather than the accounting. But it is important that there are two things that are quite important. One is that the employer and the employee must agree the furlough, and I would recommend that everything is documented. The general advice is that the employee and the employer exchange letters confirming the furlough. Probably most employers furloughed people initially up to the end of April and have now extended that probably until the end of May. But I would strongly recommend that that's documented. The second issue that has come quite a lot is that whilst the employee is on furlough, under the terms of the scheme, they're not allowed to do any work for you as the employer. I realise that might not be ideal, and it's caused a degree of consternation in a number of areas where people think it's unfair that an employee who's required to check and answer all the customer services emails, for example, once a week, can't be furloughed, whereas other employees can. But those are the rules. The second point that caused quite a degree of confusion at the start of the scheme was who's actually eligible. And the government announced a cut-off of around initially the end of February and then the 19th of March. But the cut-off relates to employees who had already been paid and were on an employee submission, an RTI return to HMRC before that date. So if somebody had started employment with you in early March, but your payday was the end of March, so they'd never actually been paid, then they were not eligible for the furlough scheme. And I've got a number of employees who've actually had to let go staff because they took them on in early March, but then they weren't eligible for the furlough scheme. Other areas where we've seen quite a lot of confusion: how to calculate the furlough pay. We've been through one cycle in August, and I suspect we'll be coming up to another one in a week or so with May. The wages that can be furloughed are the basic wages. You can't include overtime, you can't include bonuses, and you can't include commission. So this also has caused a degree of confusion where employees haven't received what they were expecting based on their general pattern of earnings in previous months, because it's only based on their basic. Secondly, employees who work variable hours. We've got quite a lot of clients who employ staff on some variation or 0 hours contracts, where what the staff work isn't consistent month on month. And here you either look back to the previous month last year for the calculation of their furlough pay, or you take an average over the last tax year, or since they started work for you, if that was before the end of the tax year. Again, this has caused a degree of confusion. I think the NI calculations are also difficult, particularly if you're topping up the pay of employees. If you are only paying employees the 80% that the furlough scheme covers, the NI calculation is relatively straightforward. It's on the HMRC guidance. You deduct the basic threshold, work out the percentage, and that's what you pay. If you're topping up the NI, you need to run your payroll and then apply a proportion of the amount of pay that's covered by the furlough to the amount of total pay to work out the NI amount you can reclaim. And that's been further complicated in April, and I suspect it will be for a lot of our smaller employees in May as well, by the employment allowance. If you're claiming employment allowance, now this is the £4,000 a year contribution from the government to most small businesses towards their employer's national insurance bill. You have to deduct that amount from the employer's NI that you're claiming through the furlough scheme. I think I can go to, there are some further nuances. Anyone who's got a pension scheme where they're not paying the absolute maximum under the qualifying earnings calculation for auto enrolment will also have a slightly different calculation to do for their furlough claim.
Have you got any sense for how many clients have, or businesses generally for that matter, have probably got their calculations and claims wrong?
We had to help. The employment allowance was probably the single major one that caused confusion last month, and also employees where we have quite a number of clients where they don't strictly pay the absolute minimum amount determined by auto enrolment, and there was some confusion there as well. I think probably where employees are paid a set salary and it doesn't vary, those have been quite straightforward. But actually, there's quite a lot of businesses that pay either overtime or a bit of bonus or commission, and have had to revise how they work out the numbers from their initial calculation to the final claim that was acceptable to HMRC. Yes. So I don't directly have a sense of how many businesses there are, but I think probably the majority of our clients have been affected by one of those items in one way or another.
Okay, and we should probably just touch on the impact of furloughing on directors.
Well, yes.
Certainly some weeks ago this was causing some confusion, but does that seem to have settled out now?
Yeah, I mean, I think that's become quite clear really. I think that there's been quite a lot of guidance issued that furlough is based about what you're paid through the payroll. It's really common for directors, and in fact, if we're offering tax advice, we would advise directors to take their remuneration, depending on the overall structure of the business, the income levels that are being generated, and there being reserves to do it. We would always recommend that where possible, directors who are also shareholders take their remuneration through a mixture of salary and dividend. And we'd probably set the salary at a relatively low level, so it gets to the threshold where it counts as a contribution for national insurance and benefits, but you're not suffering in the way of employers' national insurance, with the remaining elements topped up through dividend from the company's distributed reserves. The furlough scheme only applies to the payroll element. So if directors are being furloughed, then the amount that they can recover is purely based on the payroll element through PAYE and not anything else that they might have got paid through dividend. The second point that's cropped up with directors is that directors effectively have a statutory duties. They have statutory duties under the Companies Act to operate and maintain the company, and they owe certain duties of care to the company. One of the clarifications that's come about through the scheme is that where directors are fulfilling those obligations, that doesn't count as if they were working and therefore excluded from the scheme. So it is permissible for a director to do certain things, for example, make regulatory filings, which might include filing the VAT and so on, even though strictly they're not working.
But I think it is equally clear that what that director cannot do is anything that promotes the sales activity of the business.
Yeah, I mean that's yeah, absolutely. I mean, work isn't kind of like directly defined in the furlough scheme, but it is anything that contributes directly or indirectly to the revenue generation of the business would fall within that ambit and wouldn't be permissible.
One caveat there being that they can apply for the loans and the government aid schemes.
Yes, I mean, strictly speaking, that's not the revenue of the business. It might be monies coming into the business, but it isn't revenues as such in terms of being sales. But that's a really good point, because directors, David, are obliged to kind of like maintain the finances to maintain the success of the business. They can absolutely look at the position, plan, and apply for finance where that's necessary to secure the business going forward.
And I think one of the key issues that Chris touched on earlier is keeping a note of your decisions, and particularly this applies where there's more than one director in the business, and one director may have been furloughed and one hasn't.
Yeah.
Is being able to show, if required, at some later stage, contemporaneously, how you came to those decisions, what you interpreted the rules to be, what action you thought people could take. So at least you've got some justification for how you've moved forward. I
mean, Simon, you touched on a few minutes ago about how many people have been affected by this. It's phenomenal. HMRC have reserved the right, obviously, to go back retrospectively and audit everyone's claims, because they haven't been able to do it in order to make the payments that they have done in the times they have done. Going back to April, the portal opened only shortly before most people's payroll window for the end of April. And yet we helped quite a lot of clients make claims on the first or second day it was open, and they were in receipt of funds from HMRC in time to make their April payroll payments at the end of the month. So HMRC do reserve the right to go back and audit these, and if they find that you haven't met the requirements, then they will look to recover the monies. So Simon, you're absolutely right. Keep records of who's on furlough, why, the calculations you've made, and anything else that's relevant, because it will help should you get an audit. I've got to say that with the scale of this, and with the numbers of people that HMRC employ, the other complexities of some of the COVID matters that we might come on to, I suspect the chances of being audited are relatively small. But HMRC do have an increasing number of connected databases and some data interrogation tools, and that they may look to develop some techniques for identifying those who they feel are particularly of high risk and worth looking at.
And they also employ some very bright people who know exactly what to look for.
No comment.
So we perhaps should move on from furlough, but I'll just reiterate the point that the Chancellor is due to give some updated details this afternoon or this evening, this morning even, as to what this scheme is going to look like. Anticipations are that the scheme will continue. How long, we don't know, but some form of taper will be applied, and 60% rather than the current 80% has
Oh.
been mentioned.
Mm.
So, and one might think that now government is attempting to open more business up, that we'll see that tapering come into play. So shall we move on to some of the other major costs? And I think one for many businesses is rent. And again, I'm conscious that there are some legal and accounting elements to this. But before we go on to the loans schemes, do you want to just touch on rent and any other major costs and how these might be dealt with?
I think for most businesses, their major overhead costs are probably in the premises and the staff. The staff we've touched on through the furlough. I think I've just got one other point to make on the furlough scheme. As we see, like the announcements on Sunday and this week, that people are able to return to work if they can't work from home and the employer is able to put in place appropriate measures, and that the employer can notify the employees that the furlough is coming to an end. I've had one or two instances where employees have reportedly not been too keen to come back from furlough because they might have quite enjoyed a period of extended holiday on a substantial proportion of their pay. Now, I don't want to stray too much into the contractual matters, but frankly, that then becomes an employment law issue. If the employer decides that they're going to reopen the workplace and has the appropriate safety measures in place, and they tell the employees that their furlough is coming to the end, then the employee has an obligation to go back to work.
And you touch on it. You touch on the point that the assumption there is that it's a safe environment in which to return. So let's take that as a given. I think what you're reminding us is that being furloughed is not a right. It is something that happens as a two-way agreement between the employer and the employee. So if the employer decides employees generally or specifically should be back at work, and there are no health and safety issues generally, then the employer is entitled to take that view.
Absolutely, yes.
Yeah.
Okay, so moving on then to most businesses rent some premises in one form or another, and this is probably a substantial element of their overhead. Meeting any overheads in a period where we've had this lockdown and a lot of businesses have seen their sales, their income suffer, is quite a challenge. Our experience has been that most landlords still require their rent to be paid. And rent often in a lot of leases is not just the actual rent, but also service charges and additional costs that are related to your occupation of the premises, perhaps insurance and other items. We would really recommend that if you are unable to pay your rent, or if you're looking to defer any of it, you secure a formal written agreement with your landlord. Now, the government did rush through some emergency legislation which prevents landlords in a period up to the 30th of June from taking action to evict commercial tenants because they're in breach of their lease. The reason this is important is two things. One is in most commercial leases, if you breach the terms of your lease, for example, by not paying your rent on time, then the landlord is entitled to in other words, to bring the lease to an end and evict you. So we have this emergency legislation that prevents landlords from taking that action up to the 30th of June. It doesn't stop them taking action on the 1st of June if your rent is in arrears without agreement. I suspect when the legislation was initiated in March, just before the March quarter day for rent payments, that the government thought that this period would be over in June and we'd be back to a degree of business normality. I suspect now, looking at the measures that have been announced this week and that we'll touch on in a moment, that probably isn't going to happen. So we'll probably end up with a similar situation at the June court day, where a lot of businesses are struggling to pay their rents. Again, most commercial leases are structured so that rent payments are due on quarter days, which is approximately the end of March, June, September, and December. And these are therefore pinch points in the cash flow for lots of businesses. Landlords have been, we've seen varying degrees of sympathy from landlords actually towards tenants. Some have taken the view that they still need the funds to pay their costs, and in most cases landlords are probably quite highly geared and have their own finances to pay, and therefore need the rental payments to cover that. And where tenants have asked for time to pay or deferments of rent arrangements, the landlords have very kindly pointed them towards the C-bills and bounce back loan schemes and so on, and suggested that that's where they source the funding. In some cases, landlords have maybe been prepared to accept payment by instalments. So instead of it being generally a quarter in advance, they maybe would have accepted a month in arrears or other structures of payments. But it's really, really important that if you're not paying your rent or any elements under your lease on time, that you've agreed that with your landlord. You've got a document that says what was agreed with the landlord.
Understood. Let's move on to some of the funding arrangements that are available.
Right.
Now, the first one we got to hear about was the interruption loan, but we've subsequently had the bounce back loan.
Just before we get to that, I'm just going to touch really briefly on the grant that most businesses have now had. The small businesses have had the small business support grant of 10 grand. Retail businesses have had a 25 grand grant. Now, most businesses have already had those, and local authorities were generally very good at identifying the businesses that were eligible from their rating register and paying those out. I've got a few examples, a small number, where because of some hiccup in the rating register, maybe the business name was spelt incorrectly, or because the classification of the business wasn't right, or because the business hadn't claimed small business rent relief it was entitled to, well, those grants weren't received. So I'd encourage everyone who thinks that they would have been entitled to that grant but hasn't received it to double check their rating entries and why they've not received that grant. Now that's grant funding. The other bits we're just going to talk about now, and that I'm interrupted you on, I'm sorry, are loans. The loan, so a key feature of a loan is that it's got to get repaid.
Indeed, and there's clearly been some cases of people forgetting that. And if we just look at the first loan that came into play was the Sybil's loan.
Yes.
And then subsequent to that was the bounce back loan. But if we deal with them with the bounce back first, now it became clear relatively quickly that, well, it was always understood it was one or the other, and it's now, I believe, being clarified that if you're borrowing less than £50,000, it has to be a bounce back loan, and if you'd previously got less than 50,000 on a Sybil's loan, it will become a bounce back loan.
Right.
And I believe most people understand the basic differences. One of which becomes apparent from the government website is there are fewer lenders offering the bounce back loan. Now, what would be useful to understand, Chris, is those clients that you've got that have applied for a bounce back loan, what their experiences have been, how simple has the process been, and what are the pitfalls that might stop somebody from getting one?
When you look at the announcements, right, from the government and so on about the bounce back, tremendous scheme. Anybody who's been adversely affected by COVID can apply for this loan. The terms are fixed. It's a 6-year loan, 2.5% interest. no repayments in the first year, and the government pays the interest in the first year, no arrangement fees, and if you want to pay it back early, no early repayment fee. So really simple, and for most businesses, a 2.5% loan is actually pretty cheap finance. I think lots of the loans that we see small businesses get are priced according to various risk assessment measures that the banks use, and typically their rates are rather higher than that, and the terms are not as flexible. In terms of the application process, the lenders who are involved, and when we were going to do this seminar originally last Monday, there were fewer lenders in the scheme than there are now. In particular, HSBC wasn't in the scheme, and that's relevant because HSBC has a huge number of small business clients. So the ones that are involved have generally set up pretty sophisticated electronic portals for application, and the application process is really quite simple. Once you're as long as you are an existing customer of the bank you're applying to, and I think that's quite an important point. The banks are all who are involved in the scheme are currently prioritising their existing customers. There are a couple, HSBC is one, who will consider applications from businesses that are not their existing customers, but they have to join a queue. I think the portals opened last Monday when the scheme actually went live, and I think it's a fair comment that they were all absolutely swamped with applications from vast numbers of businesses who wanted to access this funding. What that's meant is it's taken the banks quite a long time to process all of the applications they got and deal with them. For example, I understand that HSBC only over the weekend have dealt with issued the formal application documents for portal submissions that were made last Monday, and they still have some days to go before actually releasing the funds, even though this is a really simple process. Now, one of the things that has made this process simple is that effectively these loans have been deregulated. They've been taken out of the Credit Act, so that the bank has no requirement or obligation to check whether or not the business can afford to pay it back. Most businesses, I suspect, wouldn't probably see that as a shortcoming, but it's obviously incumbent on the businesses themselves to make sure that they can pay the loan back. None of our businesses so far have actually received any bounce back loan funds, but we do expect some more news on that this week. Now, if your bank doesn't offer the bounce back loan scheme, and I've got a number of clients who bank with Handelsbanken, which has been very supportive in many ways and has delivered quite a quality service over a long period, that they're currently not accredited either for the bounce back scheme or the CBIL scheme. That they've indicated that they should become accredited shortly for the CBIL scheme, but they're probably not going to deliver the bounce back scheme. If your bank doesn't deliver the bounce back scheme, your options really are try and approach one of the lenders who might offer a scheme that doesn't require you to be a customer. As I mentioned, HSBC is one. I've also heard that Funding Circle possibly will be extending their offering to the bounce back loan scheme. They're currently accredited for the CBIL scheme, or you'll need to switch bank. But at the moment, changing your business banking between banks is likely to take a while because of the number of bounce back and COVID loan scheme applications that the banks are dealing with. This is one of the other issues. I'm just going to touch on this because this is relevant to both the bounce back scheme and the COVID scheme. These, although in theory we might now have left the EU, we perhaps haven't quite, and that there is a state aid restriction on what the government can do. So one of the questions that you'll be asked if you make an application for a loan is if your business is, quote, in difficulty. Now, under the EU state aid rules, one of the things this means is whether you've got accumulated losses in the business that come to more than half of your paid up share capital. And under the loan schemes, this is measured at the end of December. So for most businesses now, where we are in May, that will be based on management or draft numbers to December 19, rather than being formal, signed off or audited statutory accounts. Now, if you are a business in difficulty, that isn't necessarily an issue as long as you haven't received more than roughly £711,000 in state aid. This is I don't think this is going to apply to many SMEs. There are some slightly more complex rules in the agriculture and related areas, but we won't go into those because I think that's a little bit esoteric. So even if you are in a quote business in difficulty, you're still eligible for a bounce back or a CBILS loan as long as you haven't received less than the relevant amounts of state aid.
So just to recap on that slightly, Chris, there's some commentary in there about a business and the relationship between if the business is more than 3 years old and its accumulated losses.
Yes, no, you're right.
Are greater than its share capital. How does that come into play?
Yeah, there are quite a lot of nuances in the rules, and you're absolutely right to pull me up on that. This only applies to businesses that are more than 3 years old. A business that's less than 3 years old can't be in difficulty.
Right.
So yes.
And it's probably worth pointing out as well, because there's probably people out there that are involved with either charities and social enterprise, is that the bounce back loan is whilst there's a maximum of £50,000 on it, it relates to the income of the business as well.
Yes.
Unless the entity that's applying for it is a charity, which obviously won't have any trading income. So the particular requirement to have more than 50% of your income as trading income doesn't apply to the charities.
Right.
But and it's probably worth just pointing out to people that the detail for these schemes, the bulk of the detail, can be found on the British Business Bank website, and it's not necessarily the easiest to navigate, but the frequently asked questions sections do go into quite a bit of detail. Yes,
absolutely. And there are a fair degree of nuances. The bounce back loan is simpler and more restrictive. If we just turn a little bit to the CBILS scheme, the COVID business interruption loan scheme, the guidance on this has been refined a fair amount over the past few weeks as more and more businesses have applied, and we've seen the banks refining and modifying their application processes. I think initially that they perhaps weren't quite sure or rushed some stuff out to try and get applications in, but they're now asking in some sort of basic application forms a lot more detailed questions about the ownership, the makeup of the business, and where the funds are going, and how it's been affected by COVID. I think that the CBILS scheme is it's much more formal. There's much more delegation to the individual lenders from the British Business Bank about how they actually administer the scheme. But there are some common points. One is that if you're going to make an application, you need to be able to give the bank some confidence that your business is quite viable and that you're able to pay the loan back. So you'll need to demonstrate where you are now in terms of your accounting, where you expect your business to be over the next few months, and therefore why you need your COVID loan and what you're going to spend it on. And then subsequently, through the next 3-4 years, however long your loan term is over, how you're going to pay back that loan. I think the more information and explanations you're able to give to your bank about where your business is now, how it's been affected, how it's going to recover, the greater your chance of securing some funding.
I've certainly spoken to bank managers who've expressed a degree of frustration about the unwillingness or lack of ability of business owner managers to put any real effort into explaining the points that you raise. And I guess to some degree it comes back to your very earlier points about making sure that your accounts are up to date. You can show where you are.
Yeah.
But how much emphasis are banks putting on forecasts versus historical information?
Yeah, that's a really good question. We've seen a number of instances recently where the banks are required to assess under the terms of the scheme that the business is viable. Part of it's making sure they're not, quotes, in difficulty, which is not only that they haven't had these accumulated losses if they're over 3 years old, but also that they're not currently the subject of insolvency or liquidation proceedings. But we've also had some instances where the banks have wanted to look back at a 3-year or so of previous trading history and look at the free cash flows that have been generated and want to use that as the basis for making their viability assessment rather than the forecast of the business going forward. This isn't necessarily insurmountable, but particularly if you've got a growing business, the cash flows that you've generated over the past few years may not be where you are now and may not be what you were projecting for your requirements and repayments for a CBILS loan. So I think, again, it comes back to the quality of the narrative, the explanations of why the business is different at this point or immediately prior to the COVID lockdown, and how you see it developing. Plus any supporting information you can give to the bank that will justify your forecasts going forward. Examples might be where you've got particular contracts with customers or other supporting evidence, or orders perhaps, or indicative letters that will support your forecast. Appreciate that that's not always straightforward, but the more evidence and the more information you can give to the bank about why they should lend to you, the more likely you are to get some support. I think the loans that we've seen on the CBILS side that have been successful have been those that have got a really good, clear, structured business plan, strategy, document laid out. They're really clear about where the financial position is up to this point, including some history, where the money is going to get spent, and then what's going to happen that will make it recover and that will allow the business to pay it back. And I think
you do make a valid point, because from personal experience, I have seen businesses getting indicative offers within a matter of days. Highlight indicative offers of the types of facilities available. But that is where those businesses have presented a very, not just being able to present a good business case, but have presented the business case very well. And I think what you're saying is that banks aren't simply saying there's this security from the government, we'll take a relaxed attitude.
Absolutely.
And to the extent that might be different with the bounce back loan because of the amounts. But whereas the bounce back loan is quite clearly a term loan and nothing else, the interruption loan may take many different forms. Have you got any sense as to which banks are offering which types of lending, be it overdraft or term loan?
No, not really. I mean, in theory, all of the banks who are accredited can offer pretty much the products that a small business, an SME, would require to make an application under the loan. The overdraft products that we've seen have tended to look relatively expensive, frankly, both in terms of fees and rate. And therefore, the applications that we've seen have generally been for a term loan. I think most of the businesses that we're dealing with expect to need quite a chunk of support in the short term, so during 2020, but don't expect necessarily an immediate and rapid economic recovery. So they're looking for finance they want to pay back over a period. The banks have quite a lot of leeway in what they can offer you. So if you make an application for a loan or for some finance, and they think a different product, maybe an overdraft or some invoice discounting is more suitable, they're probably able to offer that still under the COVID loan scheme.
Yeah, I've certainly seen in some businesses that are inherently profitable and cash generative, where revenues have been largely unaffected by COVID, but their costs have gone through the roof.
Right.
As they've had to deal with all the requirements of operating in this environment, that banks have been keen to offer overdrafts because they see the problem as relatively short term, in that as the restrictions are lifted, the costs will start to come down and normality will resume to some degree. But I think it does definitely differ. Because I've heard that some banks just won't touch overdrafts, whereas others are actually recommending them.
Yes, I'm sure that's right. And we've also got some differing views between some of the banks who are taking quite a severe approach and weeding out applications at a relatively early stage. If they don't like the business history, if they don't think that there's been sufficient cash flow generation historically, if they think it's simply too early a stage business, whereas others are perhaps being able to take a bit of a longer view and are looking at things in a slightly more supportive context. I think it's I come back to the point that I made a couple of minutes ago, that your best chance of making an application is with the full levels of information and basically a high quality pack of stuff that you can of general information about your business you can give to your bank.
Can I ask a quick question?
Yeah, sure, David.
I mean, one of the you're saying a detailed forecast. Maybe you can help. I mean, businesses that were in a strong position before, and where revenue, for whom revenue has just sort of disappeared. How do they make? How can you give them advice on how to make an accurate forecast of what recovery assumptions will be? Because we don't really know. And I mean, the bounce back loan, for instance, requires you to guarantee that you will pay it back in good faith. Obviously, it's a very difficult thing for an SME with potentially a sort of small, not a highly profitable business, one for whom cash flow on a month-to-month basis is important. If this drags out for another 9 months, a lot of these businesses will fail. Whereas if it goes for 3 months, there's a possibility they'll survive. I mean, effectively, the bounce back loan is a 3-month bridge loan. I mean, if it's capped at 25% of turnover, I mean, it's not. But if that is the case, then it is capped at 25% of turnover. Implicitly, the government is saying it's a bridge loan for 3 months. So that's a very convoluted question. But I mean, I get the sense it's very difficult for SMEs to actually gauge what the future is going to be.
Yeah, I mean, I think just I think. Oh, sorry, Simon. You go first.
I'll taking for the first thing is a forecast is a forecast. It is not. It is nobody can predict the future. If we could predict the future, you'd go to the bookies, put it all on whatever, and that would be it. Life is sorted, financially sorted. This comes down to as the same issues that apply when you're seeking for funding, either finance or equity in normal times. When you produce a forecast, firstly, does it add up? And I can speak from personal experience. I've been presented many business plans to review where I'm given a forecast that physically doesn't add up. The spreadsheet has an error in it. So, secondly, does the forecast cover profit and loss, cash flow, and that one thing that many entrepreneurs ignore completely, the balance sheet? And does it link all of these together? Now, the most fundamental aspect of any forecast is when I sit down with the owner of that forecast and start to ask them about it and where the numbers come from and the assumptions on which they're derived, the biggest failure of any forecast to succeed in raising money is that the owner cannot talk to their own numbers. They cannot explain it. And this is part of the frustration that I mentioned earlier that bank managers are encountering. So everyone understands that it is your best guess estimate of what you think is going to happen and why you think it's going to happen and how it might differ, and if life doesn't turn out as you thought it, what the implications will be. And if the best you can do is to do a P&L on a spreadsheet, then even with the most modicum of spreadsheet skills, whether you can talk to your numbers or not is a matter for you and how you demonstrate your understanding of your business. And if you can't do that, nobody's going to back you. Chris, what your thoughts?
No, that's absolutely. I mean, I think we tend to get quite a lot involved in the mechanics, and our issue is with spreadsheets and so on that are used for forecast. We often spend a lot more time talking about how the Excel is constructed in the forecast. Whereas what we'd really rather talk about is the assumptions that underlie it. So why do you think you're going to get this level of revenue? Now, David, nobody knows what's going to happen or when lockdown's going to end and so on. So all you can do is make your best estimate and document and record your assumptions of why you think this is going to happen and some explanation. So you've got a reasonable basis putting those numbers together. You know, once you've, in most cases, we start with revenues. Where are your sales going to come from? Why are they going to be that amount? Why are they going to be at that point? Then we work down through the costs, and actually often the fixed costs are a lot easier to forecast because we know how much our staff costs are, our building, insurance, and the other stuff that goes into the office. But the crucial thing to start with is making sure that the business owner effectively is also owning those assumptions. You know, that they believe that that's where the sales are going to come from, and that's where, you know, that there's a reasonable basis. I have this contract to deliver X. I think that will get delivered here because I've got these people doing this work, and so on. You know, there are loads of other examples about how you construct it. Now, it's never going to be. It's in the nature of forecasts that they will never be right, ever. But it's your best guess at the point in time based on reasonable assumptions. I've got to say that
it's giving the reader
yes,
the confidence that you understand it well enough that when life turns out differently, you will manage that business through that change.
Yeah, I mean,
and
we've got. Sorry, Carol.
And the other aspect that I find, given the number of forecasts and business plans I'm asked to read, is how many forecasts seem to hover in some form of suspended animation and don't take into account the starting point from which they are intended to be created.
Yeah.
Because if you give me a forecast that starts from the 1st of May, but you haven't given me any management accounts since last October, then how do I know the starting point for that forecast is correct? And so many times have I seen a forecast that shows either profitability being achieved or, more importantly, cash flows being managed, that when you plug the up-to-date starting point into it, suddenly a massive hole appears. And banks, investors are looking for those sorts of issues because they've seen it all before. If you can deal with that and head those concerns off early on, your credibility rating goes much higher.
Fair enough.
I think that's a really valid point, because everybody knows right now that even if you're starting your forecast from this point, that most businesses have got some creditors that they haven't paid for the past couple of months. So that's, it's got to go into your forecast. it's really critical to start from a point you can justify. Here's my current, and we're actually seeing this now increasingly, that the banks in the CBILS loans are asking for, show me your current list of debtors, your current list of creditors, show me that your bank is reconciled in your forecast, so that your starting point for your forecast is a valid position in terms of working capital. The other thing that we're seeing in some of the CBILS loans is that the banks are asking for some sensitivities in the forecast. What if what if Boris extends the lockdown for another 3 months? How does that affect your forecast? Will you need more money? How will you survive? And some of those issues are financial, but quite a lot of them are about management. And quite a lot of the issues that come out of the forecast are about how is the business managed and what do you do about things, as well as the financial numbers.
Okay.
Now, you touched on a little while ago, Chris, you mentioned early stage businesses in particular. Yep. So we would be remiss not to mention the Future Fund, the details of which were announced last month, but curiously, the update in early May is still absent. I'll not wishing to put any bias on what you're about to say, but I think it looks good on paper, but quite frankly, is probably absolutely useless in the form it's being presented at the moment. But don't let me colour your judgment. But what's your initial thoughts on the Future Fund?
The Future Fund is in outline terms, for certain businesses who've already raised some money from outside investors. What the Future Fund does is it allows investors to put some money into a business as a convertible loan, bridging finance, I think they refer to it as in the document. The government will match your convertible loan, and at some point in the future, your loans will get converted into equity, and the government gets some favourable terms in exchange for providing you with the money. I think this is going to have a relatively limited application, if I'm blunt. I think there are relatively few businesses that will meet the initial criteria in the way in which the money's been raised and what they're looking to do. I think there will be relatively few investors who want to make convertible loans, partly because I think a convertible loan is likely to be, if they're at all entitled to any element of the EIS scheme, whether it's the income tax relief or the CGT deferral, they're probably going to want to do that rather than make a convertible loan, which is going to fall outside EIS. If they're investors which may be institutional investors or they're not within UK tax, then it may have some attraction, but I'm not sure that there are going to be many businesses that are able to take advantage of it, particularly as right now, if you wanted to make an application, you can't. So if you're a business that's accessing your funding needs now, you're really driven towards a COVID or CBILS or a bounce back loan for amounts less than 50 grand, rather than waiting to hear what the Future Fund might offer you.
Well, absolutely right, because early stage businesses that are probably too early to attract institutional money do rely on private investors who typically want EIS.
Absolutely.
Now, whilst I can understand that from a government perspective, that tagging on to a lead investor, which effectively is what they're doing with a convertible loan, makes it a relatively, from a decision-making process, easy in, easy out process for them. But the question is that I would be asking myself is, am I going to forgo my EIS reliefs just because the government is putting half the money in? And the conclusion that I rapidly get to is no. And it seems to me that given the reliefs that are available, I'm better off risking an investment where I make the full amount than making 50% of the amount and bringing the government in with me. Now, I think everybody probably understands already that convertible debt is not EIS qualifying, and therefore the two are not compatible. But I think I'd also be very worried if I'd got an existing investment in that business that had got EIS on it. I'd be very concerned about interrupting my existing EIS status on that investment by taking some convertible debt subsequent to it. So I know quite a number of us through different channels have made our comments plain, and perhaps this is why the detail is being somewhat delayed in coming out as various people scratch their heads as to see how they make it work.
Yeah.
So you know, again, I'm quite sceptical. I can't see much of it happening. But putting that aside, looking at clients generally, have you got many clients that are still looking to raise equity investment?
I think we deal with quite a number of businesses at varying stages, which are always, some of which are always interested in raising further finance. I think at this particular point, we've got a number of potential businesses that are probably deciding that the economic conditions mean they can't show forecasts and economic growth that supports the valuation that they want. I would say, I'm sure you've seen stock markets have taken a bit of a tumble around the world, and I think some of that also applies to the smaller VC or equity type, the risk type equity investments, where valuations have taken a bit of a downturn, and that's probably affecting people's perspective on whether or not they raise money right now. I'm sure, on the other hand, we've also got people, investors potentially with cash or access to finance, who are looking for bargains. Because at this point in a cycle, sound businesses are always going to recover, and there are always potential bargains to pick up. I think I can think of several businesses that were looking to engage in transactions, and they've decided the economic conditions aren't quite right just at the present. They're not going to achieve the valuations that they wanted, so they have decided to defer their fundraising or sale activities. However, I come back to the points that we made when we were talking about the loans and putting together your plan and your strategy. Just because nothing is happening right now, may be an opportunity to make sure that the documentation you've got that's in looking for finance is up to date, upgraded, takes account of what you've done to manage the business through this particular juncture. Because the same as we said about the bank loans, investors are looking for directors, for managers, for owners that are able to actively manage the business and deal with issues. Does that sort of answer the question?
I think so. I mean, you raise an interesting point about valuations, and I'm quite familiar with being presented valuation formula that amounts to, this is how much money I need, this is how much control I'm prepared to give away, plus or minus a little bit of sentiment. And that's about as technical as it gets.
Right.
So you know, I just wonder how owner managers who take that approach as their primary approach will deal with the concept of having to refine valuations downwards just to take into account market sentiments.
Yeah, tricky. We try and balance that probably with some kind of slightly more formal valuation model, whether that was based on earnings, EBITDA, prospective EBITDA, adjusted EBITDA, or something, and an appropriate multiple. And I think so. Typically, with small businesses, we'll use a valuation multiple based on earnings. The earnings might be adjusted to reflect costs that are either not included but need to be because the directors are managing it themselves, but not taking any money out, or additional costs that have been incurred due to a startup phase but aren't going to recur in the future. I think what we're seeing probably is a slightly more severe view on the multiples that people might be looking at, and also a slightly more severe view on prospective earnings in particular, where again, depending on the business sector, because some businesses will do well out of this, the COVID issue. I mean, there's no doubt that some sectors have picked up quite a lot of business, but in the majority of cases, we're probably seeing a slight downgrading, or indeed a significant downgrading of earnings. And for some of the businesses we've got in the growth phases, the earnings that they expected to generate in 2020, they're probably deferring now until 2021. They're expecting this year to be pretty much a standstill, or indeed a bit of a loss. But I think everyone understands that that's down to a COVID issue rather than necessarily a particular business-specific issue. The sectors that we're seeing doing quite well, some retail sectors where people are able to deliver items that people can consume at home, and the food sector particularly. There's been such a shift in demand for supermarkets and other retail outlets selling food that the food sector is doing pretty well. One of the paradoxes in that is that the agriculture sector is suffering from the fact that they can't get workers to deliver the food, because they were heavily reliant on transient, on migrant workers coming into. I mean, this is the stuff that was in the press last week about picking asparagus, for example. That they can't get people to come and pick the crop.
Yeah, and I think what you also seem to be saying is that there's clearly a link between the valuation and the forecast that you were discussing earlier, because if the valuation is being derived in part or to a large extent by future performance, as opposed to historical, then the accuracy and competency behind the forecast becomes even more vital. And I think what you also seem to be saying is you're expecting a bit of a resurgence in vulture capitalism, as we saw after the 2008 crash, as those with cash reserves will be looking to exploit or take advantage of market conditions.
I think when market conditions are difficult, if you have cash, you're always able to take advantage of the bargains that are around, because often valuations go down further than they need to. I've got a number of clients that have taken opportunity of the stock market falls, for example, to top up their pension schemes. Because although they might not be investing right at the bottom, although we might see some further declines this year, over a period, markets are going to recover globally. And the same, I mean, if I get the 2008-9, I do particularly remember there were some particularly significant hits on property, where developers couldn't finish projects, couldn't secure finance. The banks just weren't lending on property, and individuals or institutions who had the cash and the appetite for risk to take on those were able to make, over a period, being able to take a slightly longer term view, were able to make significant amounts of money because the property market did recover quite well. Yeah.
Now, I'm conscious that despite that being a very quick canter through a number of current issues, we have already gone well over time, and that's before we've taken any questions. David, what do you have any particular questions from viewers that you wish to ask? Or
yes, well, I mean, I think you've done a good job of answering quite a few of them. So the charities and social enterprises support question was very much answered, and the question about how people deal with their bank not offering any of the schemes. So be it Bank or some of the new fintechs, Tide, Starling, some of them are coming online with some of these products, but it typically seems that if your bank doesn't offer it, you do have to transfer banks. So you've also addressed many of these issues very well. So I think that, a lot of the questions that people did have were answered. I mean, one question that I think you also touched well on this, recovery forecast assumptions and having a breadth of recovery assumptions in there for businesses 3, 6, 9, 12-month horizons when business conditions will return to normal, being a good strategy to make sure that you are able to potentially get some financing, and equally something to consider yourself within the business if you are taking on financing.
Even if you're not looking for financing, you need to know where you are and how much you're going to be able to take out, how your business is going to survive. So you've got to do some forward projections.
Yeah. I wanted to tell people how they can get in touch with Banks Cooper Associates if they do have more detailed questions about their businesses and how you could potentially help them.
Oh, sure. Well, I mean, our website, bankscooper.co.uk. We've got an email address, inquiries@bankscooper.co.uk, or our phone number. It's on the website. But we're probably better off dealing with online inquiries right now. Like most other people, we're working from home, which has a few complications in dealing with the phone communications. But by all means, drop us a note or get in touch, and we're happy to speak to people.
Excellent. Well, I know that. Sorry.
I think Chris and the team clearly would be happy to take some inquiries from viewers. I should point out, of course, that in a forum like this, we're only having a general discussion, and people shouldn't take anything that's been said as formal advice. But if there are issues that they want to clarify, then get in touch with Chris and the team.
Excellent. Yes, no, absolutely. As you say, it's just a general discussion, and you should always seek advice from your accountant or your lawyers if you have specific questions relating to your individual business. But I'm conscious that we have gone quite a bit over time, so I think we will have to wrap this session up
Great.
But gentlemen, I want to thank you very much for your time this morning. It's been a pleasure having you on, and a very informative session. The details of Banks Cooper Associates are in the comment section, and there'll be a replay of this video available immediately after we finish here. So if anyone would like to rewatch it or didn't get the content, I know that many people will come on and watch this afterwards. So
Right.
I want to thank you very much for your time this morning.
Thank you.
Pleasure.
I want everyone to stay safe, and thanks everyone for joining us.
Great.
Cheerio.
Now.